Just imagine for a moment, you do everything right. You save, you invest, you trust the advice you're given, and years later, you realize it didn't work out the way you thought it would. How would that make you feel? I bet you're like me, a bit like me anyway. When someone says you can get market gains with no risk, when someone says you can get a guaranteed paycheck for life, there's some part of you that don't immediately thinks, what is the catch? And yes, there is a catch. We're going to talk about that today. Most investors don't lose money in a crash. They lose it slowly and silently. In fees, they never fully understand. And today I'm going to show you how one of the most trusted products in finance is doing exactly that. I'm going to show you what advisors and insurance salespeople call a guarantee are not what you would call a guarantee. I am going to show you, more importantly, and expose the hidden fees that are draining the wealth and stealing the growth out of these annuity products. That's where we're headed today. And I hope you'll stay with me. There's a lot to cover. Annuity sales. Annuity sales, 200 to, or not 200, 480 billion in last year. Helene Olen, an author of Pound Foolish, a recognized financial columnist who's been writing for years about the financial industry and has written a book, Pound Foolish, makes it very clear. Annuities are often sold for one reason and one reason only, to benefit the financial advisor. That's what she said. You can talk to any number of people. The number two recognized person in the world is Susie Orman. She also says negative things about annuities. So just imagine that. Imagine trusting someone to guide your financial future, only to discover the recommendation benefited them more than it benefited you. You know, let me ask a simple question. If I took 20% of your retirement, would you notice that? If I took 20% of your retirement, would you notice that? Because many investors experience that, exactly that. They just don't see it happening because it happens over a number of years. How does it happen? I'll tell you that. But first, why do investors buy annuities? It's all about fear or greed, or fear and greed. And it all starts with fear. You're sitting in a seminar, maybe it's a free lunch or a dinner. The room's full, the presentation begins, and they want to get you and the rest of the people in the room talking. They want to know what you know about the economy and what you know about finances and what you know about investments. They want you to express your concerns and your fears. And we're living in a time in which there's a whole lot of fear going on. There's a whole lot of questions about what's happening in the economy, what's happening with finances. You know all those stories. They want you to express the concerns and fears, and they want to demonstrate their expertise. And when they get into the fact presentation, it's slide after slide. Social Security is uncertain. The Social Security Trust Fund is going to run out of money. Same is true of Medicare and Medicaid. Taxes are going to have to rise dramatically to cover what's going on. Healthcare costs are exploding. The stock market is riskier and it's so volatile. And taxes are taking a bigger and bigger chunk of your nest egg. Slide after slide after slide, all negative news. And then the question, are you one of the 47% who will run out of money in retirement? Will you outlive your money? And at that moment, you're no longer just listening, you're feeling it. That's the presentation that was meant to make you feel it. And then comes the solution. It doesn't have to be this way. Sigh of relief. And only at that point do they really reveal the answer: a variable annuity, or promising market returns, market upside with no return, with no risk. Or they offer you a fixed rate annuity, a steady income stream. Only they never say the word annuity. They use words like, it's a solution, protected lifetime income, contractual guarantee, personal private pension, a guaranteed paycheck for life, or my favorite, market downside protection. I'll bet you might be a lot like me. You don't believe something that sounds too good to be true without asking a few more questions. So let me ask you, just out of curiosity, what do you know about how these products actually work? What do you know about how they actually work? So what's the guarantee? The word guarantee is one of the most powerful words in investing, and also one of the most misunderstood. Today, we're going to unpack what it really means. And it isn't what you think it means. It isn't. Who guarantees the money? Do you know? NOLHGA, the National Organization of Life and Health Guarantee Organization. But it's not national. Each and every state has its own fund that plugs into it. It's not like US Treasuries. It's not even like the FDIC. How has it worked in the past? Insurance companies set aside some of the premium you pay into the state organization, which is part of the national organization. And when they do, that is to cover any life insurance company or any insurance company that is putting out annuities to guarantee them, in their words, guarantees. But do insurance companies fail? Actually, yes, they have. During the last stagflation time in the 1970s, and I remember that period of time, in the 70s and the 1980s, over 150 insurance companies failed. Over 150 failed. And during that period of time, payouts were delayed, reduced, or restructured. And it wasn't the small companies. Small companies failed, medium-sized companies failed, and large insurance companies failed. Mutual Benefit Life, founded in 1845, was considered the top company with a conservative approach with an A+ rating, and it failed. NOLHGA, which is the organization that was guarantor, took 3 years to move those annuities to another insurance company. 3 years. For 3 years, you got nothing. You didn't get monthly payments. You didn't get your principal back. You couldn't get your principal. You decided you needed the money, you'd take surrender charges or whatever else. Not possible. It took 3 years to get the money moved. Baldwin United, another of the largest insurance company, it failed. And what NOLHGA did was they froze all the payments for nearly 4 years. And then the payments were not paid at the 7 or 8 or 9% that they were guaranteed to be paid. They paid them at the lowest possible rate, 3.5% to 4%. The payments frozen for the guarantee. The guarantee doesn't mean that the payments continue even if the insurance company fails. It means the payments can be frozen for years. It means the interest rates can be cut. What they promise you get may not be what you get. And what they promise, consistency in payments, may be frozen for years. That's what they mean by a guarantee. And don't worry, you're not alone if this is the first time you're hearing this. Most people are never told the full story. And you're not alone. No one ever told the financial advisor or the insurance salesman either. They don't understand it. And until they dig into it and really research it, they don't remember. You're paying, and the fact is, you're paying a lot of fees for that. Some of the money you're paying into goes to the NOLHGA. Some of the money you're paying, and that's the guarantee you're getting. Remember I said earlier, if I took 20% of your retirement, would you notice what you're paying into NOLGHA is only part of the story, is only part. There's more, but before I discuss the fees, let me move on to the variable annuities or the index annuities. They guarantee market participation with no downside risk. What does that mean? They have a cap on how much you can get. They have a cap, say, of 9% or 8% or 10%. So if the market goes up 20%, you collect 9%. And what you give up for that, give up for the difference, is you don't get the downside. Sounds great, except how does it really work? Every 2.5 to 3 years, the market is up 20% and you're giving up half the returns. Every 5 years, the market's up over 30%. And now you're giving up over 20% return what you would have. We've seen that in the last few years. We've seen the market up 25 to 30%. If you collect just 9%, that's what you're giving up. Think of how much you're really losing. You're taking the ride, but you're not getting to the destination. And you don't even get 9% when the market is up 9%. You know what? Remember, I told you. I asked if I took 20%. If I took 20%, would you notice? Let's talk about the fees. Let's talk about the real fees. Because the annual fees that you see that are in the document that you can see before the hidden fees are as high as 3.8%. They go to the national organization, they go to the state organization. You pay a couple percent just for the right to have the insurance product. The fees that they disclose continue on and on. 3.8% off the top. 3.8%. And that's before you even get to the hidden cost. You know, commissions for financial advisors who take a commission can range between 5 and 14%. Where does that come from? Do you know why you have surrender charges? That's because if you opt out of the annuity too quickly, they've already put out 5 to 14% to the insurance salesman or the financial advisor who's commission-based. That's what you're reimbursing the insurance company for with those surrender fees. It's not a coincidence that they pay 5 to 14%. That's incentive. You don't see it. The insurance company takes it out of the returns or the bonds, stocks or the bonds in your portfolio. There's no free lunch. There's no free lunch. Even for the fee-only advisors, they're making 1% a year. If you hold that for 10 years, they're getting paid 10%. And those are the fees that you can see. But they're not the only fees. Layer upon layer of fees in the annuities. There's the hidden fees in the mutual funds and the funds that are making up. Number one, most insurance companies for annuities, they drag 0.25% or 0.5% off the return. Compare a mutual fund in an annuity, compare that to one that's outside an annuity, and you're going to see that the return is 0.25% or 0.5% difference. That's going to the insurance company. It's a drag off the top. The mutual funds have an expense fee, the expense ratio, but more than that, they have fees within those mutual funds. They have a cash carry cost. They have an asset management fee. They have marketing fees. They have trading cost. They have brokerage commissions. If they have spread costs, market impact costs, soft dollar cost, redemption fees, account fees, and purchase fees. And that's not an all-inclusive list. But those are fees which you never see, which are never disclosed because they're part of the investment vehicle inside the annuity. Those are fees, they're hidden. Those fees can take up to 60% of your growth. And that's in addition to a cap on a variable annuity or a fixed indexed annuity. Just imagine what that does to your portfolio and your wealth. Just imagine 5 or 10 or 20 years without that constant drag on a portfolio. So what future would you rather move for? I started this workshop podcast saying this. Just imagine a moment. You do everything right. You save, you invest, you trust the advice you're given, and years later, you realize it didn't work the way you thought it would. How does that feel? That's what you're hearing today. Most people never realize what might have been. When I worked the big brokerage firms, the mantra was sell the relationship, not the performance. Make clients like you. Behavioral finance is an area of economics that fuses with psychology, describes often irrational behavior of individuals when faced with financial choices based on a variety of biases and heuristics. Often investors, unaware of the underlying biases that are at work and that can underlie bad decision-making. Sell the relationship, not the performance. We're going to spend next week talking about behavioral finance because our minds are not wired to be math calculators or computers. Our minds are wired to be hunters and gatherers, not to be statisticians. We're going to talk about this whole idea of behavioral finance and why it works against you, why it works against the financial advisors, and why you may not be getting the best advice. Comes down to the fact that financial advisors, whether they're with big firms or small firms, are focused on selling the relationship, not the performance. Make the clients like you. Make them your friends. Don't ever tell them how poorly they're doing. Because if they do, they're going to find another advisor. Statistically, 1 out of 4 clients sense that they're not getting the best advice and not getting the best performance, but only 3% of clients actually change advisors every year. They rationalize. They say every financial advisor is the same. Every financial advisor is going to give me the same advice. So why would I change? The fact is, the numbers don't lie. And here's where I get to tell you about what we do. This is how we do. If you look at this chart, you'll see that the average financial advisor over this period of time from the bottom in 2009 to the current time, they turned a $500,000 investment to an average of 1.2 million. Seems pretty good. Grew over 2 times. Our clients grew 500,000 to 7.5 million. The idea is we're facing some difficult times now. Which line would you rather be on? There's 2 types of people in this world. Those who leave their financial future to the hands of average returns, and those who take responsibility and demand that their money work harder. I would guess that a lot of people that are watching this program are a lot like me. You've worked too hard to leave your fortune and your future to chance. You don't want fancy pie charts and bar graphs. You want to see results. The most dangerous threat to your retirement aren't the ones you see coming. They're the ones that look safe. They're the ones that look like annuities, or the ones that look like a financial plan where everything is molded together, where you reduce the risk, where the mantra is sell the relationship, not the performance, where the mantra is don't lose money, don't lose money, don't lose money, don't take the volatility. That's where we are. Hopefully today you learned that what seems to be a very safe and nice investment can just slowly eat away at your wealth. And with that, I'm going to ask if there's questions and discussion.
Hey everybody, it's Chris Prouty and I am back. Mike, a couple of questions that are queued up. Somebody asks, so should I get my money out of an annuity if I have one?
I would start that process today. Why?
Is Go ahead, go ahead. I,
I mean, you just heard what the guarantee is, what
mm,
the fees are, and what the limits are if you have a variable annuity. It's a lose situation. It's not
hmm
safe, and it's not guaranteed. It's not the kind of guarantee that you would expect with the word guarantee to have. Yeah, eventually you get your money. Eventually, maybe.
What should Mike, next question. What should I say to my advisor if they put me in an annuity and it's the wrong thing?
I want to,
hmm
you know, advisors get paid a lot to do that. Is that the kind of advice an advisor you really want? That they put their benefit over yours. And in many cases, they do it unknowingly. They think that they're doing good because the insurance companies put a huge sales premium on doing it. Can't tell you, I hear once once a week, maybe not quite that often, from annuity companies that tell me how much money I can make and how good I can do for my clients. And when I ask the questions about the guarantees and the fees and the rest, they usually hang up the phone and don't want to talk to you.
Mm-hmm.
So
So my JJ comments in the chat, once you're in, there are huge penalties to get out.
there are, indeed, there can be 10%. I haven't heard of anyone paying more than 10%, but you're giving up that no matter what you do. You can either start to grow and increase your funds more today, or you can just settle and wait and eat away at your nest egg by waiting for the surrender charges to go away.
hmm
I can show you, we have had a number of people that have given up their annuities with significant surrender charges. And within less than a year, they've more than made up the surrender charges with improved performance.
hmm
Less than a year
Wow.
to make up those surrender charges.
So then
Can't
that,
guarantee that. No one
that
knows
address,
it crystal ball, but
well, that addresses the question, what happens if I surrender it? What's it actually going to cost me? But it sounds like you've got a plan for that.
we have a plan and it's
Yep.
worked.
Yep.
And why we can't guarantee that, like annuities guarantee. What we can say is this is our track record, and this is what we've done for people in the past. And we feel that there's a significantly high probability we can continue to do it into the future. We have a
Mike,
path.
Mike, somebody's asking, is there anything better that still protects from the downside?
Um, you can do CDs and get your
Mm,
2%.
mm,
Um, no, I mean, the reality is, if you look at where we are, volatility is the price you pay for better returns. And in today's inflationary environment, I've done programs on inflation. Inflation will will destroy your purchasing power by 70% or 80% over the next couple decades. You know, that's putting your money in what are called safe investments that never have any risk. Volatility is the price you pay for better returns. Does that make sense?
It makes sense. And Mike, somebody just makes the comment, it's nice to actually have someone that will give me unbiased advice on this.
No,
It's nice comment.
I can't say that I'm unbiased. I can tell you there's very, very few people that should have an annuity. I can tell you that I have a cousin who should have had an annuity. When his father died, they sold his house, and within 2 years, all that money was gone. He had an accident that he got a big settlement for, and he came to me and wanted me to manage the money. And I looked at where they were. And when I talked to him, they were talking about buying an RV that was going to cost $89,000. And they had other things they wanted to spend on. For that person, locking up that money in an annuity would have been the right thing to do so that they couldn't take the money out. That RV will not serve them very many years anyway. I can give you another story. I had a young woman who was 21 years old, went through medical malpractice, received $250,000 for medical malpractice. And when I talked to her, I said, you're going to hear from relatives and friends, relatives you never knew you had, friends you never knew you had, and they're all going to have great investment ideas and great needs. And I said, you need to be able to say no. And if you can't say it, refer them to me and I'll tell them no. But she had a sister who couldn't get a home loan because their credit was so bad. So she had to loan and give part of the money to her sister. And then there was a real estate investment of property. Yeah, it was 5 or 6 miles out of the city, but eventually the city would reach that limit. And so it was a good friend who had this great investment. And yeah, they owned the property. And so you have to buy the property and just wait on it. And at 22 or 23, maybe in 50 years, the property will be worth a lot more. But one after another, a 21-year-old who would have been set for life had she continued, went through the entire 250,000. I regret not telling her you should have an annuity. So you cannot get your money on it. It doesn't matter what relatives say. It doesn't matter what your sister has. You should have an annuity so you can't touch the money. And even though you won't have anywhere near the return over the years that you would have, you will have money when it gets to the point that you want to retire or you want to give up what you're doing instead of being completely out of money. And she has nothing. This is 20 years later, nothing. She's in her 40s. Nothing. Anyway, those are two people that really needed an annuity. Do most investors need an annuity? Absolutely not. Absolutely not.
I love those stories, Mike. Mike, somebody asks, could you please type the name of the book and author you spoke of at the beginning? Mike, if you'll tell me that, I'll find the Amazon link for it. What was the
The
name of
book I spoke about in the beginning was The World is for Sale. I can't remember the author.
That's all right. I'll find it.
It's a fairly recently published book talking about the world of commodities and how it's changed. My workshop, my podcast from last week, a lot of it was based on information from that book. Very, very good book. Very interesting. Very interesting to know what's really going on in the commodity world. And if you missed last week's workshop podcast, you should go look at it because it makes sense when you see what's going on today with oil prices at $100 a barrel, 150,
Mm.
$180. When you see helium, half the helium production in the world has been shut down because it's in Qatar. When you see the price of silver that was way up and then falling off, when you see the prices of commodities and silver and copper, makes sense. The world
Mike,
is
is
for sale.
Mike, the world is for sale. Power and the traders who barter in the earth's resources?
That's it.
Okay. Jerome is saying he thought he heard the name Tom Foolery. Is that what am I missing here, Mike? Did you mention an author named Tom?
I don't remember the author.
Okay. The author for this one is Javier Blas and Jack Farchi. Let me see if there's another version.
So, other questions? If not, let
I
me
don't
tell you
have any,
about Nick.
yeah. Mike, I don't have any other questions queued up, and it looks like that's the only book I can find that's called The World is for Sale. So I popped the link into the chat for everybody here.
Okay.
Oh, a book about annuity fees, Mike. Did you reference a book about annuity fees?
Oh, I didn't reference a book about annuity fees.
Okay.
Um, that that comes from a number of different sources. Oh, the book I mentioned was Pound Foolish
Ah,
by Helene Olen. Her last name is Olen. First name is Helene,
I have
Helain.
I've got the link coming right now.
Pound Foolish, Exposing the Dark Side of Personal Finance Industry.
There you go, everyone. I just put that link in the chat as well. And also up above in the link, I put the link to the YouTube channel and Mike's direct email address. If you want to watch replays of any of these broadcasts, you can find those on the YouTube channel. And if you do go over there and you find value in the information that Mike presents every week, we'd love it if you would subscribe to the channel so you can get alerts every time Mike posts a new podcast and be the first to get that information. And then I also put Mike's email address up above in the chat, which you can email. And I have on good authority that Mike checks, reads, and responds to every single email that he gets. And Mike, with that, I don't have any other questions. I've got all the links into the chat. Why don't you bring us home, Mike?
And we do use this as a workshop and we put it on a podcast. So if you're seeing this as a podcast, do subscribe. We'd appreciate that. So
Mm-hmm.
coming up next week, behavioral finance says that the biggest risk to your retirement is not the market. It's usually you. We're going to be talking about that next week. Our
It's a great title.
brains are wired so that it becomes a personal issue, not the market.
Ah,
And with
great
that,
title.
and no other questions, please come back next week and see the podcast. Take care. And baseball season has begun. Play ball.